All right, guys, episode 10 of the series here. We are now moving away from context and focusing on location. When we're talking about location, we are referring to supply and demand zones. So in this video, we're just going to be defining them and talking about what they represent and just really laying the base. So supply and demand zones are areas on the chart where institutional buying or selling activity overwhelmed the opposing side, creating a market imbalance that defines a high quality region for potential risk taking. So either buyers or sellers overwhelmed one another. That created an imbalance in the market. And so that location where that imbalance exists acts as a high quality region for us to potentially exercise our risk at upon revisit of that imbalance. So on a surface level, that's what these supply and demand zones are. They are areas in the market that have transitioned from balance to imbalance. So more specifically, what do they actually represent? What are they on a deeper level, and how do they form? So we understand that they're imbalances, but more specifically, these locations in the market, these imbalances, they contain resting institutional liquidity that remains after strong institutional buying or selling created the imbalance. So keyword here is created. Understand that on any given day in the S&P 500, nearly half of the volume that's being supplied is being facilitated by institutional entities. So options desks, portfolio managers, prop firms, hedge funds, you name it. These entities trade with such large size in the market. They supply so much volume, so much capital that, for example, when they're looking to take the market long in the S&P 500 for 5,000 lots or so, before they can get all of those orders filled, the imbalance will have already occurred and price will move away from the area at which they are looking to get their orders filled. And so as price is moving away, that is the imbalance that's being created within the market. But back to the point here, I say that these institutional orders create the imbalance, right? They have so much size, so much capital that they manipulate price, they engineer these levels, they create the imbalances within the market. So institutions create these levels and they trade with such large size that price moves away before they can get all of them filled. And so the reason that this is important is because we can then align with that institutional activity and that liquidity that's still sitting there as price pulls back into it for a potential opportunity to take the market long in demand and short at supply. So that is the whole concept of supply and demand zones. But yes, they represent institutional buying and selling that alter the supply and demand equation, creating a location in the market that goes from equilibrium to imbalance, right? And so when price pulls back into it, as I've said, that is when we hop in, and that's when we look to ride that momentum to see if in demand buyers are stepping back in, if that liquidity is being filled, and if buyers are actually stepping in to defend that location for a move back to the upside, right? So demand imbalances are areas where institutional buying overwhelms selling pressure. The definition that I like to, or that I've thought of myself, is that the willingness of buyers to buy at that location was stronger than the willingness of sellers to sell at that location. That is my definition of a demand imbalance. Here's a bit more of a formal, boring definition though. Supply imbalances are areas where institutional selling overwhelmed buying pressure. So the willingness of sellers to sell at that location was stronger than the willingness of buyers to buy at that location. And that is what actually formed the imbalance. So that's what these zones are. Most people do not filter supply and demand zones, but as supply and demand traders, it's absolutely a non-negotiable that we're doing that. The markets are always changing. There are always different environments where demand is going to be more favorable, supply is going to be more favorable. And so having this contextual filter before we actually look at these zones is really what sets CLC apart from most supply and demand trading strategies. And so in this next video, we're going to go ahead and talk about how these supply and demand zones pair up with our contextual analyses.